Welcome to this week's Market Update, where we review the key developments that shape markets, highlight what drove our recent performance, and look ahead to important events on the horizon. Let's start with what moved markets this past week. The big themes were continued AI investment, rising stocks, and higher bond yields, creating new income opportunities for investors. Artificial intelligence remains one of the most powerful forces shaping markets today. Microsoft's latest data center expansion confirms that hyperscalers continue investing aggressively to meet enterprise AI demand, and the company has already secured over 40 gigawatts of renewable energy to support this build-out. For our portfolios, this reinforces why we maintain a meaningful exposure to technology leaders in cloud computing, semiconductors, and enterprise software, as these companies are direct beneficiaries of multi-year investment cycles. US stocks continued their impressive run this week, with the S&P 500 on pace for its sixth consecutive week of gains. Falling oil prices, steady treasury yields, and strong results from technology and digital platforms all supported investor confidence. This combination of moderating energy costs, solid corporate earnings, and improving sentiment creates an attractive backdrop for the quality growth companies we hold in our portfolios. Over to the bond market, long-term treasury yields approached the 5% level this past week. And while higher yields can create short-term movement, they also open up income opportunities that we haven't seen in many years. Importantly, stocks continued performing well alongside elevated yields, supported by strong corporate earnings and ongoing AI-driven capital investments. For our clients, this is exactly the constructive environment allowing us to pair quality equity holdings with attractive bond yields to create a more balanced income-generating portfolio. Now let's look at what drove our performance over the past week and why we remain confident in our current positioning. Eli Lilly was our top performer with a remarkable 15.96% gain as investors rewarded the company's leadership in the fast-growing market for obesity and diabetes treatments. Strong demand for their key weight loss drugs, combined with progress on the new oral obesity treatment, continues to drive their momentum. With expanded global adoption and upcoming Medicare incentives broadening patient access later this year, Lilly remains a strong long-term leader within the global healthcare innovation. The communication services sector led our performance, with nearly all of our holdings posting strong gains. Alphabet surged nearly 14%, while Meta, Netflix, and Spotify also delivered impressive returns, reflecting renewed confidence in digital advertising and subscription growth. Our communication services companies generate substantial free cash flow and benefit from the same AI infrastructure trends powering broader market gains, making them durable holdings for long-term portfolios. Our size strategy was once again the week's strongest performer, with mega cap holdings like Alphabet, Apple, Tesla, Eli Lilly, and Caterpillar all driving meaningful contributions. During uncertain times, investors naturally gravitate towards larger, more established companies because of their financial strength, global reach, and resources to invest in next-generation technologies. This rotation reflects something important. Scale itself has become a competitive advantage in today's economy, which is exactly why we emphasize quality leaders across our portfolios. Looking ahead, here are the key events that we're monitoring that could shape markets in the coming week. Tuesday brings the latest US consumer price report, giving us our broadest look at inflation trends. While headline inflation has temporarily moved higher to 3.3% due to energy spikes tied to the Middle East tensions, food inflation has eased and shelter costs are stabilizing. For our portfolios, easing pressure in core categories supports our view that the Fed has flexibility to maintain a more balanced policy approach over time. Released alongside the headline number, core inflation strips out volatile food and energy prices to give us the clearest view of underlying trends. The encouraging news is that core inflation has remained well behaved at 2.6% annually, with monthly gains holding at a moderate 0.2%. Steady core inflation is a positive backdrop for both equities and bonds. On Thursday, we'll get the retail sales report, which has recently delivered excellent news for the economy. March's report showed retail sales jumping 1.7%, the strongest pace in a year, with broad-based spending across autos, furniture, electronics, and online retailers. Strong consumer activity supports corporate earnings and reinforces our positioning in quality companies with pricing power and lasting competitive advantages. Thanks for joining us, and we'll see you next week.